I'm very pleased to join the Singaporean Corporate Governance Week, and many thanks for the invitation to Securities Investors Association, David, and also I'm very pleased to be with a very distinguished panel. Roger, our chair and moderator today. We have Sir Jan Duplessis. It's a great pleasure to meet him online, and we have Professor Tin, and also Marcello Bianco. Maybe most of you know him. He was the former chair of the OECD Corporate Governance Committee. So he's probably the best person to comment on the current draft out there. So again, yes, my name is Serdar Çelik. I'm acting head of the Corporate Governance Division, and I'm very pleased to join the conference. It's very timely because again, as you may know, OECD, G20 and FSB member countries are currently reviewing the G20 OECD Corporate Governance Principles. We made a draft public a few weeks ago, and we are in the middle of a public consultation. Process now, and collecting comments from both authorities, regulators, stakeholders, institutions, and academics around the world. And we have a few weeks to go, and then OECD countries, G20, FSB countries, they will meet in Paris to discuss the revisions and the comments. So let me just adjust maybe my screen just to see the slides well. Okay, perfect. I can see it. So I will start a bit giving of a background, what is on the principles, what is the principles about, then the kind of the owner of the principles, OECD Corporate Governance Committee, and then I will talk also about the current revision, what are the issues we are discussing currently within the committee and with other stakeholders. So just a note, I cannot see the slides. I don't know how this will work. I can only see myself, so this makes it a bit difficult. Maybe
we can see your slides. We can see your slides. Please go ahead.
Yes, that's perfect. This way is perfect, so I can see the slides at the same time, and I can comment on them. Great. Thank you very much. So the principles are originally developed by the OECD in 1999. So they were developed as OECD Principles of Corporate Governance. But what happened? In 2015, they were endorsed by G20 leaders, and they were renamed as G20 OECD Principles of Corporate Governance. Since then, I mean, their visibility, their impact have increased significantly. They become more visible, and also especially in the non-OECD countries, in the emerging world, and in non-OECD G20 countries. As you may know, India, for example, China, Saudi Arabia, South Africa, Brazil, they are not OECD members, but they are G20 members. So first time both OECD, G20 members and FSB members like Singapore together, they endorsed a set of corporate governance principles, which and then be named as G20 OECD Principles of Corporate Governance. So one thing I would like to remind, the principles are not primarily targeted at the companies. They are targeted at regulators, authorities, in some countries, stock exchanges, in some private initiatives, but in a country who has the power, authority to regulate corporate governance. It is not targeted directly to companies, but since the 2015 revision and the G20 endorsement, we also see that in many company documents, they are referenced and used, but they are mainly a public policy tool, a public policy instrument. The current principles have 6 chapters. One side is on more regulatory legal aspects, the role of the shareholder rights, responsibilities of boards, pretty legal text. And the other part is on the functioning of capital markets, the stock markets, the intermediation, some intermediaries in the system, even ESG rating providers to other rating providers, proxy advisors. There is a chapter on disclosure, of course, disclosure and transparency, and there's a chapter on the role of stakeholders. So in addition to the G20 endorsement, also the Financial Stability Board endorsed them as one of their 12 key standards for financial stability. This is where also Singapore, as a member, also joins the FSB endorsement, and then of course they are kind of used by World Bank as their core standard for corporate governance assessments. Currently, all OECD, G20, FSB members plus Bulgaria, Croatia, Peru, and Romania, they have officially adhered to these principles, which is more than 97% of the global market capitalization. So next slide, please. So who is the kind of the owner who is doing this work? It is the OECD Corporate Governance Committee. The committee is currently chaired by Vice Finance Minister of Japan, Mr. Masato Kanda, and all OECD, G20, and FSB members are members of the committee with equal voting rights. And even again, some of them are not OECD members, but they are members of the Corporate Governance Committee with full membership. The committee, one part of the work is corporate governance, the principles, their monitoring. The second part committee also focuses a lot on capital market issues, especially from a non-financial company perspective. So non-financial companies access to public equity market, non-financial companies issuing of bonds, bondholder rights. And then there is a special work stream in the committee, which particularly focus on state-owned enterprise governance, either listed or non-listed. On the corporate governance side, the mostly focus is on the companies that issue securities, but on the SOE side, state-owned enterprise side, the work is both listed and non-listed state-owned enterprises. And the committee has mainly three instruments. One is the corporate governance principles, but we also have a guidelines for state-owned enterprise governance and also guidelines on anti-corruption and integrity in state-owned enterprises. Next slide, please. So, and the committee's discussion, what basically, I mean, this is a bit of a simplification, of course, but in committee's discussion and also in the principles approach to corporate governance, why a committee is interested, or what is the public policy role for corporate governance, why we are interested from a public policy perspective. The first one is to promote access to finance, innovation, and entrepreneurship. So there is a committee believes that good corporate governance is needed to access to finance from markets, and there's a very strong link. We show it in OECD studies. There are also other studies from IMF, from others. There's a very strong link between market-based financing and innovation, entrepreneurship at the company level. And the second issue is, of course, protecting investors, because you are asking people to invest in your money, in your securities. So the good corporate governance public policy should protect the investors. And the third one, more maybe a bit of newer, maybe at least from the perspective of the principles, to support the sustainability in the corporate sector and in the broader economy. And next slide, please. And a bit of background in the discussion in the committee from the access to finance innovation link. One thing that committee was particularly concerned over the last years is the decline in the number of listed companies around the world. So we had, before the 1999, as you may know, dot-com bubble, we had around 60,000 listed companies. Then before the 2008 crisis, we had around 50,000 listed companies. Now we are around 42,000 listed companies around the world. So there has been a decline in the number of listed companies, especially in the US, from 9,000 to 5,000, and many European markets. And of course, there is one particular concern here, what we saw during the COVID crisis in 2020 and 21, especially 20, for example, and 21, it was the kind of the years that the companies raised most money from the markets, both from the equity side, from the bond side. It was the highest ever issuance in real terms, in even inflation adjusted terms. So many countries, many central banks, regulators, their main purpose was to keep the markets open during the crisis, and it pretty well. Markets were open and companies were able to access to finance. But what we observed was they were mainly open in the left-hand side, on the, for example, the green side. Green part is the slide. This is the equity issues by already listed companies, so secondary public offers, not the initial ones. So what we saw was mainly companies that were in the market that already issued equity. They were able to tap the market a lot with very high volume. But companies that were not in the market, especially in the first year, they had struggled to come to the market. That is even more visible in the bond market, corporate bond market. That it was the lowest amount of issues by first-time issuers during the 2010, 20, and then 21. So if the companies were already frequent issuers, they benefited a lot from that access, but if they were not, they did not. And so that was a bit of a concern, how to make capital markets more fit for newcomers, maybe younger growth companies. And the second one on the right-hand slide is a bit of a issue we will also discuss on the ownership structure, on the maybe there is a link with company groups. What we have observed, of course, there has been a decline in some countries in terms of listed companies, but there has been an increase also, especially in Asia. And you see in the figure, China had the most IPOs over the last 10 years, almost 3,000 IPOs. And many Asian companies were the same. Even if you kind of extend the list a bit, you will see that Vietnam had more IPOs than Germany and France combined over the last 10 years. Of course, what does it mean from a global corporate governance discussion? One aspect is that the composition of listed companies around the world has changed significantly, also towards more concentrated ownership structures. Next slide, please. And on the protecting investors on the left figure, we show the current ownership structure. So this is based on our original work, based on the 30,000 largest listed companies in the world. So we look at the ownership structure one by one and try to classify who are the owners of equity in today's capital markets. Of course, the biggest group is, not surprisingly, institutional investors. I mean, that's a big change, but it has been over the last 20, 30 years. Now almost 42, 43% of all equity around the world, again, this is for 30,000 largest listed companies, is held by institutional investors, pensions and insurance mainly, and mostly pensions are very big players, as you know. This is, if you think about the current market capitalization of around $100 trillion, so approximately $20 trillion is held by pension funds. And this is a bit of of course, an important discussion from corporate governance perspective. In some countries, this was already the trend, especially US, UK, of course, they were always an important player increasingly, but especially in other countries, emerging markets, also even including some large Asian markets like China, Japan, for example, the growth of institutional ownership investments have been really significant over the last 10, 20 years. And other owners are corporations, so these are companies holding securities of other companies, 10%. Strategic individuals, these are not retail, these are kind of owners of the family companies and holding companies. So basically 20% is in the hand of families and holding companies, and 10%, it may not sound high, maybe to some of you, but 10% is owned by public sector now in the listed companies. So this is, I mean, this has been a big change globally also on over the last 10, 15 years. And next slide, please. And the third dimension I mentioned in terms of the public policy objective is the corporate sector sustainability and resilience. As you may, as we are all aware, one big discussion is the climate change and the materiality discussion. What should companies disclose to public? What we did, we also did a study of, we issued a paper also called Corporate Reports, a very detailed report on corporate governance and climate change in June this year, also to support the discussion. In that report, what we did a study of, okay, let's look at from a climate change perspective only, if it is a financially material risk for what percentage of the companies. And the report finds that almost 2/3 of the companies in the world now, climate change is already a financially material risk. So what was our message is, because, you know, I mean, there's this big discussion if they should be disclosed, not disclosed. We said, let's a bit maybe move ahead and leave this big discussion behind us, especially from the climate perspective, if we should disclose, companies should disclose or not disclose, but focus on our work is what should be disclosed and how should we do this. And on the second part is on the right-hand side, the slide is on the debt. As we know, the debt in the non-financial corporate sector has increased significantly since 2008, especially the issuance of corporate bonds has increased significantly. I mean, this is a good development in one way, especially the use of bonds, which is longer maturities and market-based financing. So, but the concern there is what we see at the same time of that increase of debt financing, we also have seen a decline in the quality of issues. So the quality of debt issued to the public has declined also significantly, with lower quality for investor protection and lower quality for ratings. So it's a bit of, again, all these are very detailed, discussed in our reports we issued to support the revisions. There are 7 reports on our website with all the detailed data information about the background on all that kind of, and there are many other, of course, issues. And next slide, please. So based on that discussion, again, on the reports at several meetings, the corporate governance committee identified 10 priority areas for the revision. Of course, a very long list as a priority. No, normally maybe priority should be around 3 or 5, but since the issues are very broad and it's 53 countries, different legal traditions, different priorities currently, we ended up having a list of 10, and they are all very important. And the first one is the management of ESG risks and their disclosure, digital risks, opportunities, other one, increased ownership concentration and the trends, as I have described state ownership, family companies, group companies, their increased role in the market. But also there's one other concentration, which is concentration in the hands of large institutional investors. I mean, 20, 30 years ago, the largest, let's say 10, 20 investors come together in a developed market, probably wouldn't have the majority of the shares. But now almost in every company in the world, like more than 70% of the companies in the world, if the top 10 investors come together, they have the majority of the voting rights. That has been a really big shift from like 20 years ago when the principles were first developed. So we see even in the hands of institutional investors, families, state, there is a huge concentration ownership in the hands of a lower number of investors. The role of institutional investors stewardship is, of course, a key issue. Crisis and risk management, especially risk management in line with the developments during the COVID, because many companies, as you know, were also criticized not being able to manage the crisis well, not just not being ready enough, but also not able to manage the process or these 2-3 years of crisis period. Excessive risk taking in the non-financial corporate sector. This is mostly linked to non-financial companies issuing low quality bonds and with, again, lower rights for investors. The role of rights of debt holders in corporate governance. This is the first time we have a discussion on this, how to integrate them. One reason why we are doing this, of course, half of the listed bond issuers in the world are listed companies now. So there is a huge overlap in terms of issuers of bonds and issuers of equity. Executive remuneration discussion. One important one here was that committee was concerned that in many countries we have seen some practices that companies change their executive remuneration policies in the middle of the crisis quite frequently. So normally the expectation was this should be longer term policies, but we have seen that there were many changes during the crisis to adjust to and this created some kind of tensions within some companies' ownership. And the role of board committees, audit committee, traditional committees, but also emerging new committees like risk committee and sustainability committee, and diversity on boards and senior management, not from only a gender perspective, but broader diversity perspective. Next slide, please. So in terms of the revisions, I mean, again, the draft is public, so I will not go very detailed, but one thing what we are changing, and so far we have received a lot of comments and reactions, is the first part about the principles. They are kind of the chapeau describes what is the principles and how the OECD or the G20 countries see corporate governance public policy. And we are trying to integrate the 3 dimensions, like access to finance, protecting savers, and sustainability about the principles in the new updates. And the big change, of course, is there is a new chapter on sustainability and resilience. It talks about disclosure, it talks about the role of shareholders and sustainability, the role of boards and sustainability, and the role of stakeholders from a different dimension of sustainability discussion there. Next slide, please. And one other big issue is the company groups. This is in some countries, especially in Asia, we know that this is not a new topic, and many countries have advanced a lot in terms of the company group governance. But this is, globally speaking, it's a bit of a relatively newer topic. And there are lots of issues we have discussed and the committee discussed in terms of risk management, in terms of the kind of the disclosures within the group, the responsibility of board members within the group, within the subsidiaries, how should this be regulated, and of course, the key issues related party transactions. So there are some suggestions about this company group, making it a stronger framework for company group governance in the draft principles. Institutional investors and stewardship code. When the principles were last revised in 2015, it was relatively maybe less comprehensive, maybe revision compared to this one. The stewardship code, only a few countries have stewardship codes, but now among the 53 countries in the committee, more than half have a stewardship code. So this has changed. Stewardship codes have become a kind of a main tool in corporate governance. So we are trying to reflect these changes. And of course, as we know, with the increase in ESG ratings and ESG investment practices, ESG ratings and index providers are increasingly playing a bigger role in corporate governance discussion and also impacting the company governance. So we have some provisions related to this. And the next slide, please. And the third, again, a summary is we have because our focus to digital technologies is one side is from the supervisory perspective, how should supervisor use digital technologies, but also in terms of the opportunities and risks for companies. There's a discussion a lot going on in terms of the annual shareholder meetings. In some countries, there's a strong kind of desire to push for also online voting, like a simultaneous voting at the shareholder meetings, also virtual shareholder meetings. In other countries, they have some concerns about this practice, equal access by shareholders to electronic shareholder meetings. So more tendencies hybrid than only virtual. So there's some provisions under this, which is a kind of it has been so far a bit of a hot topic for discussion. And board responsibilities and duties, of course, again, the risk management, executive pay, and also a bit strengthening the committee language in the draft. And the other one is there are two draft provisions addressed to corporate debt and bondholders. One is the rights of bondholders in listed companies. The other one is the disclosure of covenants, the bond contractual contracts. As we know, I mean, some companies, for example, during the early times of the COVID, they had some difficulties in paying back their debt, but they wanted to restructure their debt. And these were listed companies, but they were not able to do it because there were some contractual obligations in their debt contracts, which kind of prevented them from restructuring their debt. But this was not known by the public or by the investors. So there were some concerns about the transparency of the debt obligations for listed companies. And the next slide, please. So these are basically the areas, and again, there are revisions around all the 10 topics and in the draft. So the process actually started last year with the OECD committee deciding to revise the principles in April. Then G20 leaders and OECD ministers endorsed that decision in October last year, and we agreed with the terms of reference in February. Had 2 committee meetings already in Paris discussing with all countries the draft. Now it is out for public consultation, and then the committee in November will meet in Paris to continue discussing the draft. The current timeline is an agreement in March, then it will be adopted by the OECD ministers in May, June, and will be presented to G20 leaders' endorsement next year under India's G20 presidency with the new principles. And then next slide, please. As I have a bit mentioned, we have developed several reports with very original data analysis and the discussion, all background of that discussion and the revisions. Why did we make that revisions? They are all available on the OECD website. You can maybe just Google OECD corporate governance. You will see the reports are there and the draft is there. And we look forward to receiving comments from everyone interested, all stakeholders, either individual and institutional. And we will be very happy to receive the comments on the draft. And we will work to develop a new version to present it to the countries for the continuation of the discussion. Next slide, please. And I think that is all on my side. Thank you. And thank you very much for your attention. And I look forward to the discussion. Thank you.